Hi, this is Daniel with Unrivaled Investing. Today we're going to talk about Lemonade. The company is revolutionizing the insurance industry. It is growing at hyper speed. What's the point of this video? My goal is to go over Lemonade, not the drink. How big is the opportunity? What do their financials look like? And at the end, I offer a free investment calculator for you to pencil out what you think your returns could be investing in Lemonade stock. Free to you. And that link is below the description of this video for you to think about, hey, what's the risk reward for owning Lemonade stock? Is it a 10x from here? But before digging in, if you like videos that talk about can this company be a multi-bagger? Can it go up hundreds or even thousands of percent? I recommend that you subscribe to this channel. If you're already a subscriber, hit that like button. And if you want to know what I'm personally buying or selling in any given month, go to unrivaledinvesting.com to follow my personal financial journey. Also, if you're already a subscriber and you have a question or you have a stock that you want me to look at, feel free to leave a note below in the video. So what is Lemonade? Lemonade is revolutionizing the insurance industry by taking a technology-first approach to underwriting and customer satisfaction. Underwriting is the process of insuring individual customers, saying, hey, we will cover you against XYZ risk. That is what underwriting is for a cost, which is the premium that the customer will pay you. So the money that the customer pays you or pays the insurance company, that's the premium written, and the insurance company is underwriting the risk that they will have to pay against a claim from the customer. Lemonade is just starting. They just started with the renters and homeowners insurance markets, but this is just the beginning. And ultimately, this is a bet on artificial intelligence. This is a bet that Lemonade is going to disrupt the industry by being a pioneer in artificial intelligence. But first, what is the perception of insurance companies? And what was my initial perception of Lemonade before doing any digging in? Like, it's always good to think about, like, what's your perception before you look at something to understand, is there a possible disconnect between stock price, stock valuation? Let's dig in there. And my initial thoughts when I heard about Lemonade was like, yeah, that's great. Really fast insurance company that's losing lots of money. Yeah, I'm gonna have to take a pass on that. But that was before I actually started digging in. What's the public perception of the insurance industry? And here's this great clip from Urban Dictionary, where insurance is a business that involves selling people promises to pay later that are never fulfilled, with hashtags scams, Ponzi. And the diagram that you see below, where you see these customers are handing cash over to the insurance company and they're just perpetually, fighting over those dollars. That's generally how the industry works. You do have this sort of conflict of interest where you're paying money, but the insurance company wants to keep that money, so they don't want to pay the claims. So how do you possibly revolutionize a industry and problem that has gone on for hundreds of years? Because keep in mind, insurance as an industry has been going on for hundreds of years. How can Lemonade possibly disrupt this? They're doing it. So the first is by taking a tech-first perspective. That means an ease for new customers. It's never been easier to get coverage or claim payment. If you have a problem, if you have a real claim for Lemonade to pay out, it's never been easier to receive those funds. How about affordability? They're cheaper than the competitors. How about brand? Customers love it. How about alignment? Customers are aligned not to cheat the system. What? We'll dig into each of these points as this video progresses. I just want to give you a highlight of some of the things that give Lemonade an unrivaled value proposition. The next point is data. Lemonade takes a data-first approach, which creates a truly unique advantage in the space. Each of these points are driving an unrivaled value proposition. Regular viewers know I look at all prospective investments through the lens of an unrivaled value proposition. The reason why that lens is so important is because it automatically discards 95% of the investments out there, because most companies are not unrivaled. But when you are unrivaled, It means you offer a good or a service that others simply don't compete with, whether or not it's on price or on service. So if you are unrivaled, it gives you the right to win. And when you have the right to win and you're in a big market, that is generally a formula for really fast growth, because other people aren't competing. You're tapping into a big market. You're going to grow. Let's dig into each one of these points so that way you can understand Lemonade that much better. First is ease. So new customers or potential customers chat with AI Maya, and they're doing it on their phone. This is a tech-first company that uses the AI Maya uses natural language and makes the process fun and easy. It's funny, if you go to Twitter, you'll see people talk about like, wow, that was so easy to get renter's insurance, to get homeowners insurance. And why is it important that it's an easy process that you can just do on your phone and answer a couple of questions? And the reason why is because you can get homeowners and renters insurance in 2 minutes. This is like mind-blowing. This is a revolution for the fintech industry. This is a revolution for the insurance industry, because previously you would have to work with a broker or an agent, and they would help you with dozens of their own questions, and they would source it out to many different agencies and source it to many different insurance companies to say, who can I get the best quote from? This is a revolution because from a customer perspective, all it takes is 2 minutes. A couple minutes, boop, boop, boop. You're messaging on your phone. Boom, you have renter's insurance. Boom, you have homeowners insurance. What about making claims? Claims are filed by talking to another bot, which is AI Jim, who completely handles from the initial processing to payment, everything, soup to nuts, 33%, so about a third of all claims. This is incredible, and assigns the rest. So the other 2/3 are assigned, to individuals, to real people, based on workload, specialty, and their schedule. So this is AI Jim handles not only 1/3 of the claim business, but also delegates the workload. Now, this is incredible because so you have a claim, you had a flood in your kitchen, or there was a fire, and now you got to get this all replaced, and you had insurance for it. You can do a video, you're recording yourself, you show it, you send it, and just think about it, like how much easier of an experience that is. You're effectively texting this AI, and it can process 1 out of 3 claims. It's going to get processed, and you're going to get payment. Think about the cost savings Lemonade is going to have relative to all their competitors that's used to this very manual, people-driven process. This is software eating people, because 1/3, and it's only going to get better over time. Their algorithm's going to get better and better. Maybe someday it's going to be 50%, maybe even more, where their algorithm's going to know, we should pay this, we shouldn't pay this. These are the additional questions we're going to need to ask. This is truly revolutionary stuff. If you want to bet on AI and disrupting an industry, Lemonade seems like the way to do it. I already talked about the cost savings. What's the catch? Like, you'd presume, like, if you're introducing an algorithm to make these claims, there has to be some sort of catch. Maybe it takes longer for you to get paid. And no, once again, you can get in payment in as little as 3 seconds. This is incredible. Like, imagine your home just got vandalized, and you want to get some sort of compensation. You want to file a claim. You can get money that day, like that hour, depending on, like, if the algorithm accepts it's 1 out of 3, you're going to get the money back like that. That's incredible. In as little as 3 seconds, it's like, boop, you got the funds. How can Lemonade possibly, like, you can tell, my mind is blown. This is something that traditionally, like, the insurance firm is like, no, let's hold off paying as long as possible because we need those funds and we're going to collect money off of those funds. How can Lemonade possibly afford this? And the answer is that 90% plus of homeowners insurance policies in the US are sold via agents. Now, Lemonade goes direct to consumer. So, the consumers are going to Lemonade, they're signing up via the app, signing up via the website. And because you're not having to go through a broker or some sort of agency to sign up, and the agency's, not asking questions, the agency, the broker, they're not going to be the one that's going to be handling any sort of claims you have, because it's all done directly with Lemonade. Your cost, that cost of a broker, which all these other insurers have, Lemonade doesn't have to pay. So they're going to be able to pass on those cost savings by going directly to the consumer, to you, by offering lower premiums for your renters and homeowners insurance. And the discount is up to 50% savings versus some of the other insurers out there. Now, is this a feasible, sustainable model? I would think so. You can see Geico has literally been playing that model for decades, where they were the direct consumer for auto. And it's, hey, don't use a broker, go straight to us. Let's own this brand. And if you do that, we'll succeed. I think Lemonade is the new technology version of Geico, but with homeowners and renters insurance. And they're disrupting the space. They're going direct to consumer. They got the cost advantage. They're doing everything. I'm getting ahead of myself. Let's keep going. What does all of this mean for Lemonade's brand? And the answer is that the customers love it. Here's a quote from ClearSurance. Customers rate Lemonade as the #1 ranked renters insurance company in the US out of 300 plus renters insurance companies. That's incredible. I mean, when you see a data point like that's like, okay, you have something special going on. There's 300 other players out there and you're ranked #1. That fits with building a thesis of you have an unrivaled value proposition. You see that with the number of stars that they have, or their rank on the different app stores, where they have a greater ranking, a greater customer satisfaction than something like a Netflix, which Netflix and chill, baby. Their net promoter score, and this score calculates what percentage of your customers would recommend your service to others, is over 70%. That's incredible for an insurance company. Most people hate their insurance companies, or do not like their insurance company, or at best are ambivalent, like, it worked out. That level of net promoter score, 70%, 70 plus, that's aligned with companies like Apple, Tesla, people that love their brands. So why could this brand loving on the Lemonade brand? Who doesn't love Lemonade, really? Why is Lemonade and branding so important for shareholders' perspective? Like, how could that contribute to shareholder returns over time? And the hint is S&M. And by that, I'm going to dive straight into the answer. The answer is sales and marketing. If your customers love you so much that they're referring other customers to you, then your ad dollars can be that much more efficient, and you can spend less on advertising than your competitors. Lemonade's automatically spending less on brokers because their business model is different. They're a direct to consumer. But if you're have such a strong brand that other people are like, oh yeah, we're going to refer you, we're going to refer customers your way, then you're going to have growth without even having to pay for it. So that only reinforces your operating margins. It only reinforces how much lower you can charge your customers. This is creating like a virtuous win-win cycle. So if you're a trusted brand and paying out claims really quickly, how do you mitigate fraud? Because there's always going to be some percentage of the population that wants to game the system. That's just reality. There's always going to be a bad apple or a bad lemon. Sour lemon, is that what you'd say? And here's how Lemonade is doing it. They're doing it with the alignment. So Lemonade maintains status as a B Corp. It's a designation for social and environmental commitment. Now, a B Corp, I've just learned, is not technically a legal anything, but it's a designation overseen by a nonprofit organization, effectively saying, like, you're an entity for good. Do no evil. We're the entity. We're a nonprofit that confirms that you truly do no evil, which was once like Google's mandate. They do this do no evil approach by having a give back program where any excess premiums, so effectively money they made on their customers, they make too much. Like, they charge this, and like they want to set aside 70%, for claims, and 30% for gross margin. And they're actually making way more than that on a given premium. On your premium, they said, it's sorry, you're on your policy, we actually made too much money on it. The proceeds, that delta, that difference, will go to the charity of the customer's choice. That's incredible. So the customer has buy-in to say, like, oh yeah, if you actually make money on me, I want the funds to go to this charity. And they can choose based on a list of charities that Lemonade has already chosen. So this is especially appealing to Lemonade's younger customers, who are inherently distrustful of institutions, and they like a brand that aligns with their values. A lot of people think insurance, they think AIG, they think about the financial institutions that blew up in 2009. This is a whole new, very fresh take on the industry. But, one should argue that this could have downside as well, because, with insurance, it's good for you to be able to keep that buffer. It's good for you to, like, if you have good times or you do have things that are better than expected, it's good for you to have that extra reserves. And I'm sort of conflicted about it. I don't see all the data that management sees that leads them to the conclusion that it truly is a net positive. Does it drive lower churn? Does it drive lower fraud? I can't see the full extent of that data, versus the additional benefit of having those reserves that you can reinvest in your growth. So I can't tell for sure. I'm going to have to trust management. Management has a lot of skin in the game. So I'm a little conflicted on it, but I could definitely understand the appeal and how this is disrupting the industry, and creating alignment with the customers. So that way you're sort of breaking down a problem that's occurred in the insurance industry over literally hundreds of years. So the last component that's driving this unrivaled value proposition is data. Lemonade is a data-first organization that enables the fast underwriting and payment. Now, for example, when a prospective customer is talking with AI Maya to get their initial policy, you're only asked something like 13 basic questions. But while you're interacting with it, selecting what your answers are, AI Maya, so this AI is actively collecting 1,600 data points. This is in real time. This is the reason why they can underwrite policies like that. In a minute or two, they can say like, oh yeah, we've run all of our algorithms, all of our proprietary algorithms to look at all this data we can possibly find on you to determine whether or not you're a good credit risk. Let's look at the dinosaur model of traditional brokers, where you talk to a broker and the broker asks you somewhere between 20 and 50 questions. They're then going to relay that information to the different insurance carriers. So this is a much longer process. This is the reason why there's a huge time differential. Brokers can take days or weeks. Here, Lemonade can take minutes. This is a huge deal. Being able to click 1,600 data points. This is a 10 times magnitude plus. That means you're going to have better underwriting. This means you're going to be able to make better decisions. This whole process of data first flows through the whole organization. And you can see that here by collecting all the 1,600 data points per person in that minute or two. They're collecting data that traditional insurance carriers, they simply aren't doing. So they're building this highly proprietary model to say like, oh yeah, this is how much we should charge this customer. And it's getting only better and better over time. That's what machine learning does. Now, here's the beauty of it. That data flows through the whole organization. So they can say, hey, we can tell this cohort does better, is more profitable, so we should also change our marketing strategy. Oh yeah, we should change. This is going to impact our sales. This is going to impact customer support. We see more fraud from this cohort. We should expect more claims or less claims from this cohort. All of this data impacts how they run the whole organization. This data first is a cohesive approach that covers the whole company. This approach has driven this amazing chart. And honestly, when I saw this chart, this upcoming chart I'm about to show you, this is what made me change my mind from the initial office space perspective of like, yeah, great, a fast growing, unprofitable insurance company. Like, that's easy to do. Anyone can offer insurance that's unprofitable and grow real quickly. Anyone can do that. But this chart is what changed my mind like that. And they grew their in-force premiums, so their in-force policies grew by several 100% since 2017. But the profitability of those same policies improved dramatically. It went from a huge net loss, those policies, to being about 30% profit on those policies. This is a game changer. This has not been seen in the insurance industry, where you can grow several 100% while profitability improves. Traditionally, what happens is you see an insurer that's growing real quick. It's because they're making bad offers. They're making bad deals where they're ultimately going to lose over time. They're saying, hey, we want to gobble up all this market share, but a year or two later, they've gone bust because they wrote bad contracts. Here it is, they are making better and better contracts, more and more profitable insurance premiums. And the reason why is because this isn't long tail. This is renters and homeowners insurance where it covers a set period. You're talking about a month or 6 months or a year. So you don't have to worry about that tail being off. Like, hey, we're doing life insurance and 30 years later you've gone bust because you wrote a bunch of policies that were way off. This is a game changer, hands down. Like you will not see another insurance company with a chart like this. They're playing a completely different game. This is not what you traditionally see about subscribe and save, where, I'm sure you can think of plenty of auto insurance models where it's like, I switched from this brand to this brand and I saved $500. Thank you. But this is a completely different game. As the CEO said, we're picking the fruit from the tree before it can even go in someone else's basket. 90% of their customers are newbies, never buying renters insurance before. That's a big deal. Only 10% of their customers are switchers. So they do have that cost advantage, but they're growing real quickly because they're tackling effectively a new market. They're creating a market of new buyers that have never gone through a process like this before. And not only are they tapping into this market, and seeing that chart that 90% of their customers are newbies, that reflects that does reinforces this thesis of unrivaled value proposition. You're kicking butt, you're taking names, and you're tapping into a market that honestly other insurers aren't succeeding in doing. But not only are you growing by the number of people, policyholders that you have, you're also growing because the policies are growing by dollar amount. Now, here are a couple of charts here where you can see maybe they start as a renter. Then, they're sharing a place with a few friends, and then they upgrade, then they get a condo, so their policies go up, then they got a house. So you're seeing this trend where the same policyholder is willing to pay more over time because they want more coverage. So you start off as a 30-year-old where you only need $60 of coverage. Now you're $600 of coverage, you're 40, and maybe you need $6,000 of coverage when you're 50. And they're seeing that where just over 3 years, people are willing to pay 50% more for their policies because they need bigger policies. So customers increase spending. And what's interesting is 10% of their condo owners' insurance are graduates of their renters. That's a beautiful thing. So they never even had to pay for the sales and marketing dollars to get them as a customer. These customers were just like, yeah, of course we're going to stay with you. We've been super pleased with the experience. It was super easy. Why would we switch? We know we're getting a reasonable price. We know, we know the B Corp status. So if you make excess money from us, it's going to a charity. The incentives are aligned. This is incredible. What's the opportunity? When management talks about the opportunity, they talk about how insurance is like 11% of US GDP, and globally it's a $5 trillion market. So either way, you're talking about insurance being a multi-trillion dollar market where no one player, even the biggest players, are more than like 4% of the global market share. Auto insurance, you'll have a few players that are more than that, like 8, 10, 12%. But on a global perspective, they're all pretty small, single digits. Normally I don't like hearing when management says like, yeah, we're operating in this multi-trillion dollar space, and if we only capture 1%, think about all that upside. But when I hear them talk about this, the conclusion for me is they're not going to just stay in the renters and homeowners marketplace for long. They are looking at every single vertical in the insurance space and saying, what can we disrupt? What is an area that's ripe because it just has all these inefficiencies? What's an area where there's a lot of broker model, where we can disrupt it with having a tech first, a data first approach? And for example, they already announced that they're going into the pet insurance space. I have mixed feelings about that, but there clearly is a lot of opportunity in other verticals. Maybe it's life insurance for them to get into. And also broadly, they're a small drop in a huge, larger ocean. But what about their financials? So Lemonade, not surprisingly, is growing at hyperspeed. Their in-force premiums, so the premiums that they're writing on an annualized basis are up, over 100% this year. Last year, they're growing over 200%. And that's driven, as I mentioned earlier, by customers growing 80%, over 80%. So that reinforces the idea of an unrivaled value proposition. You're gobbling up all these customers. And the premium per customer, so the spend per customer, was also up in a teens rate. So they're paying more because they're getting more coverage. But what about profitability? So growth, not a question. I've talked about unrivaled value proposition that would reinforce long-term top-line growth. But what about profitability? Now, they are extremely unprofitable, but not because of their underwriting. So not because of their inherent insurance operations, their contracts, but it's because of a need for operational leverage. Think sales, marketing. You have to establish this brand if you're going to be direct to consumer. If you're going to go around the brokers, you need to be able to you need to spend a lot on making sure people even know you exist in order to have a direct to consumer relationship. Then you have, general and admin costs that every company has. So not surprisingly, they are very unprofitable, extremely unprofitable, but it's been heading in the right direction. Their relative loss ratio, you can see adjusted EBITDA as a percentage of premiums has improved significantly. It's still a big loss. Can they handle these losses? That's the next question that you might be asking. And after their IPO, their balance sheet had over $600 million. You need to back out, $100 million plus for claims, that they for reserves that they're going to set aside. But that's seemingly enough to handle at least several years of a high cash burn. And you can see how in 2020 they're guiding to negative EBITDA of 100 million. EBITDA is a very rough proxy of cash flow. It's very rough because you need to consider it excludes stock-based compensation. It excludes capital expenditures, like building new equipment. But by and large, it's a rough proxy cash burn of 100 million in a year versus several hundred million in cash. So they should be good for a few years and they should be getting some operational leverage. But what about the valuation? What's the risk reward? Is Lemonade a 10x from here? Clearly a lot of growth. It's an exceptional company, but the valuation is actually very, very tough to underwrite as an investor. Let's go into why underwriting this is so challenging from the investment perspective. So the first part is there are a lot of moving pieces. They have they do their business with reinsurance partners. So that way they don't shoulder all the liability risk. They offload a lot of that to their reinsurance partners. So that creates complexity of what if the reinsurance partners, aren't, don't hold up their end of the deal over time? And what did the economics look like with these reinsurance partners? Plus they have a new reinsurance program that started, July 1st. That hasn't been seen in their 2020 results so far. And this change, there's also a GAAP financial change where their revenue that they're looking at, they can't include their gross premium. So all the business they wrote, they can only look at it net of whatever they're owning. So anything that's being reinsured, that affects their revenue figure on a go-forward basis, not historical basis. So you can see on this chart over here that their revenues in the third quarter 2020 is going to look like it drops significantly from second quarter 20. So there's a lot of different moving pieces. There's how are they getting the economics from their reinsurer? What's the new normal for their business? So we need to take a step back when we're thinking about this and think about what do we actually know? We know their value proposition, or at least we understand why it seems like they have an unrivaled value proposition. But what do we need to know in terms of valuing Lemonade? So we know it's growing very, very quickly. I think we can build a thesis to say yeah, I think it'll continue to grow really quickly. And we also know that they're targeting gross margins of 30 to 40%. Gross margins in insurance industry, they use loss ratios, but it's effectively the same thing where for every dollar of premiums generated, they want to get like 30 cents or 40 cents in profit. So here's a direct quote from their second quarter 2020 results, where our gross loss ratio continued to improve and came in at 67% for second quarter as compared to 72. So the gross loss ratio, that's like what the cost is. So you need to think of it as subtracting from 100. So if it's 70%, then it's going to be a 30% gross margin, but it's a 70% cost loss ratio, down from 82% in the second quarter, with a gross loss ratio in the 60s. I'm pleased to note that we are now within our target range, an achievement we've been focused on since selling our first policy. We expect, and this is the key line, we expect that our gross loss ratio will vary over time within this target range of between 60 and 70%. So that means they're targeting 30 to 40% gross margin. So that's how I'm mentally thinking about this. There will be volatility in that. They are reinsuring a lot of their business, so the volatility should be somewhat muted. But we can start penciling out a margin profile. We do know we can pencil out a growth profile. Can we pencil out a margin profile? So let me walk you through some of the assumptions that I'm laying out here in this calculation, and to ask yourself, is this a 10x from here over the next 5 years? Let's walk through some of these assumptions. So around a $47 share price, and keep in mind that's way above what they IPO'd at. Their initial price was around $20. When they opened, it was much higher. So around $2.7 billion market cap, and based on their new adjusted revenue, based on the new reinsurance contracts that have gone through, their annualized revenue, based on looking at the third quarter, is around $60 million, and you can see that here. Based on knowing that they're targeting 30 to 40% gross margins, I'm going to pencil out optimized margins. What could they do in the future of somewhere between 7.5% and 15%. This is a guesstimate of what I'm thinking this could potentially do. Maybe it comes in higher, maybe it comes in lower. I want to pencil out a range of possibilities, low to high. And so that gets the operating profit that you can see. It's not huge, $9 million based on their annualized results in operating profit. Slap on a 25% tax rate, because once again, we're thinking that this business is optimizing their margins in the future. What could this be structurally in the future? And if you're going to be profitable in the future, which every business should aspire to be, then you're going to be paying taxes on it. So slap on a tax rate. And so their net earnings, just based on their current business, is single-digit $1 million. That's, like for a nearly $3 billion valuation for earnings, like optimized earnings of a few $1 million, that implies like a PE multiple, the equivalent, like a virtual PE multiple of like 400 to 900 times. That is pretty rich. I mean, even for a company that's growing at 100% plus, that's going to be tough. Like automatically you should know, like growing at 100% but valued at 400 times earnings, that's going to be tough to fill. So then let's look at this bottom component where I'm pointing at the investment period of 5 years, and what's the assumed growth rate over those next 5 years. This is the growth rate for revenue, because we're already assuming long-term structural margins above the 7.5 to 15%. So assuming some sort of growth rate of 50% annualized, that's an incredible growth rate, to 80%. And that might just be like stupid high growth rate. I mean, that implies growth relative to third quarter 2020 annualized of somewhere between 7x and 20x over the next 5 years that they grow. So growing from somewhere between 7 and 20x in the next 5 years, that's how much they're going to grow. Maybe I'm way off here. Once again, let's slap on, so you could see the implied earnings would be somewhere between 24 and 100, nearly 130 million in net earnings. Slap on some sort of earnings multiple to that. If it's 50% annualized, 5 years out, it's probably going to be growing a little slower than 50%. So maybe 30 times multiple. And then for the high side, let's slap on 50 times multiple. And you can see this is a really wide valuation range, where you could be looking at this company as worth less than $1 billion 5 years from now, which would just be just a terrible shareholder return of 70%, down 70%. Or you could see upside of 100% plus. But I don't see this as a crazy risk-adjusted return. It's sort of 1-to-1 in all honesty, based on this. Now, as usual, this is hypothetical. Like, could stock prices go way above this, way above the high range, and way below the low range? Absolutely. But this is a hypothetical for you to think about. And my value proposition to you, the viewer, is that I offer this free valuation sheet in the description of this video. You can click on it and you can play around with assumptions yourself. So say, Daniel, I don't agree with your assumptions at all. This is what I think they're going to do. Hence, this is what I think the stock is worth over time. And as someone that tries to be rational, I'm willing to pay what I think is a rational price, because I think in 5 years from now, if rationality prevails, this is going to be the valuation range. But what am I personally doing? I've highlighted, this sort of mediocre risk reward. What's my plan? And first, anything on here, it's not financial advice. Everything on here, none of this is financial advice. But what I'm tempted to do is buy either a teaser or tracker position, despite despite underwriting a lousy range of shareholder outcomes. Why would I consider doing that? This is what I'm thinking about doing, is that in the event that my assumptions are too conservative, which maybe they are, maybe, it forces me to watch them, even if they are expensive. Maybe my assumptions are too conservative. But ultimately, you won't know what I do unless you go to unrivaledinvesting.com, click on Journey, where you can see what I'm buying and selling, what I'm holding each month, the rationale for my top positions, and that's what subscribers at unrivaledinvesting.com get by clicking on Journey. And keep in mind, your patronage enables the production of these educational videos. And for the current subscribers I have, thank you so much. I enjoy making these videos. I hope you're enjoying them. And it's a journey. That's why it's called Journey. You're tracking my personal investment journey as I'm considering these companies, thinking about what price do I want to buy, what price do I want to sell, and why, and which ones do I want to partner with and just hold long term and just sort of sit on them. If you enjoyed this video, please hit that subscribe button. If you're already a subscriber, hit that like button. Thanks so much for watching.